The Trade is brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.
Hello and welcome to The Trade. Before we get into the charts that matter, let's have a quick look at what traders are watching. Canada preparing possible reprisals while the EU reports progress in trade talks as new US metals tariffs triggered more disruption in the global economy and added urgency to negotiations with Washington. US President Trump has signed a proclamation to restrict foreign student visas at Harvard University amid an escalating row with the academic institution. The Bank of Japan considering slowing the pace of tapering in its bond purchases from next fiscal year onward. This, according to 4 sources telling Reuters, and the move would signal its focus on avoiding big bond market disruptions. Meanwhile, Japanese real wages fell for a 4th consecutive month in April, eroded by stubborn inflation that's continued to outpace pay hikes delivered so far by companies. To get across all the technicals, Andrew Gagan caught up with Jason McIntosh earlier from Motion Trader.
ASX 200, it's only about 1% now from an all-time high. And this was pretty much unimaginable just a couple of months ago. So it really has been one of the great market comebacks. And the big development on the charts over the last couple of weeks is that the moving averages have crossed to the upside. You can see I've got that blue circle on the chart, just identifying where that is. And so this is the first time in 3 months that we can say the ASX 200 is above rising moving averages, and that's important. And because the 50-day moving average is now above the 100-day moving average, and you can't have a bullish trend without that condition being met. So a really important thing going on there. Prices are also becoming established above the moving averages. So again, these are positive factors that I think can support higher levels in the maybe in the weeks to months ahead. One thing I think we should be thinking about is the potential for a pullback, at least in the near term. And we can never be sure when these things are going to happen, but of course they do happen, and they're things we should consider and be prepared for. I've got another chart that I want to show you, and this time I've added an indicator to the bottom. So this is an interesting indicator. It shows the percentage either above or below the 50-day moving average that the market is currently priced. So at the moment where the ASX 200 is above its 50-day moving average. And I put a blue horizontal line across the top of the indicator, and that marks 4%. So the ASX 200 is currently 4% above its 50-day moving average. And you can cast your eye along that chart to the left. It goes back to 2012. We could have done this back to the 1980s and you get the same sort of result. And that is, you can see that the ASX 200, it often doesn't get this stretched above the 50-day moving average. And it may happen once or twice every year or so, but it's not a regular event. And when the ASX 200 does get this extended above the 50-day moving average, it's usually a good indication that the near-term upside is limited. Now, don't get me wrong when I say that. I'm not suggesting a big fall or anything is on the horizon. Often the pullbacks are shallow, only last a few weeks, but the risk reward of buying does diminish when prices are stretched above the 50-day moving average. Other factors to consider are the presence of the all-time high in close proximity, and also prices rallied quickly from below the moving averages to above. And when that happens, the market often does pause and consolidate while the moving averages catch up. For me, it's been a process of gradually buying over the last 6 weeks. And I think that's probably the way to continue playing this. I'm happy holding what's working. I'm happy buying stocks that are breaking out, stocks that are rallying off their moving averages. But what I don't want to do at this point is chase stocks that have been running hard. And that's simply due to the risk of or the potential of that near-term upside being limited. And as always, with all the stocks that I approach, it's using those wide trailing stocks to try and see off potential pullbacks, those inevitable pullbacks when they do occur.
So, Jason, that's what you're seeing on the local market. Does the same apply then when you take a look at what we're seeing on Wall Street?
Yeah, look, generally I think that's the case. I think it's been a constructive week for a constructive couple of weeks really for the US markets, the S&P 500 and the US markets generally. The signs so far are that the dips are being bought, and this is showing up on the charts in the form of a shallow pullback over the last couple of weeks. I think this is important as it shows that buyers are quickly stepping up and supporting prices. So that's a positive sign. It's when we get rallies that then are aggressively sold, that's when I think we should be concerned. But the early signs are that buyers are still trying to get into the market rather than sellers wanting to get out. I've got another chart of the S&P, looking at it from a different perspective, looking at it from an equal weight basis, which is always interesting because it weights those top 500 stocks equally rather than the big ones having the most influence. And what we're seeing here, we're seeing the same sort of price action play out. After that strong rally off the April lows, prices are now starting to find support around the moving averages. And I think it's positive that we're seeing the equal weight trade in a similar manner to the S&P 500, as what that shows is that there's broad participation in the rally. It's not just simply a case of a few of those big mega stocks carrying the rest of the market. You'll also see that the moving averages continue to turn higher, and they're close to crossing. They've crossed on the S&P 500. They're close to crossing on the equal weight. Looks like the equal weight might need another couple of weeks before they potentially cross, but I think the underlying structure continues to improve. I want to show you a factor that could be a tailwind for stocks. It's one more chart I've got for today. It's of the volatility index, or the VIX, and I'll put this on a weekly chart so we can get plenty of data going back 20 or so years. So this has been one of the fastest falls in volatility on record. And when volatility collapses in the way that it has over the last few weeks, it typically doesn't make a quick comeback. So look at the past spikes above 50. Now you see that blue horizontal I've got on the chart, that marks where 50 is. And with the exception of last August, the other big bouts of volatility, they're around at least 18 months to 2 years apart. So yes, there can be flare-ups after a big bout of volatility, but when you look at what's happened in the past, the volatility index would suggest that the main act is now over, and that this opens a path for further potential gains over the coming months. Of course, it's never a one-way street. We could get several months of consolidation, but as I say, the main act of volatility does appear to be behind us. Like I was saying with the ASX 200, I think the play here is to approach the market from the long side, be looking for opportunities that stand out. The price action to me suggests that the interest is in buying the pullbacks, not selling the rallies. And rather than looking for reasons to stay out, I think it's a case of going with what's working and managing risk.
All right, that does it for this edition of The Trade. Be sure to join us next time.
The Trade was brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.